How to start investing in your 40s. Starting to invest in your 40s can be scary, especially if you're not sure about the best investment opportunities for you, or you're still paying off student loans and credit card debt. However, taking control of your financial future now can pay big dividends later. So take the time to learn how to start investing in your 40s and get the most out of your finances. You still have plenty of time to make up for lost time later. This video offers proven strategies for investing in your 40s, but before investing, seek advice from your financial advisor. That said, here are your best moves to improve your chances of success as you start investing in your 40s. Get your finances in order. As you prepare for retirement, you must have all your finances under control before investing in a 401k or an IRA. As much as possible, get rid of any and all debt. You don't want to be carrying high-interest credit card balances into retirement. And similarly, if you have access to an employer match for your 401k, take advantage of it and max out your contributions until you no longer are eligible. That way, when it's time to invest, you won't miss any opportunity for growth. Additionally, taking care of your health can also play a key role in long-term investment success. Invest in good health by eating well and exercising regularly. You might even consider seeing a doctor for routine checkups. After all, living well is not only healthy but also enjoyable. Once you've addressed these financial issues, you can start investing your money effectively so that it will last long after retirement has begun. Decide on an investment strategy. No matter your age, investing can help you save money and accumulate wealth over time. But there are specific strategies that work better for some than others. If you're starting to invest in your 40s, it may be a good idea to find an advisor or online tool that helps you identify where your retirement dollars should go. Think stocks, bonds, and mutual funds. Taking steps like those can help ensure that your investment strategy is one that suits your risk tolerance, budget, and other long-term goals. Once you've found a strategy that works best for you, it's important to stick with it. Think long-term. The best investors think long-term. As you get older, it becomes harder and harder to invest without taking too much risk. You're not as nimble as you were when you were younger, so now is an important time to focus on creating wealth for your future needs. Whether that means investing for retirement or saving for a house down payment or just setting money aside for a rainy day, as it probably will be, thinking about big picture goals is more important than ever. Don't waste your money on quick fixes. It takes time and effort to make smart investments work. But by taking some time now, you can maximize your long-term chance of success. By thinking more clearly about where you want to go and what steps you need to take, you'll have greater peace of mind with every investment decision. Still unsure how to start investing in your 40s? Look into what options are available with your employer through a 401k plan. Or if other types of plans are available like 403b plans, IRAs, etc. That said, make sure there is no limit on how much salary or dividends or interest can be contributed every year. Invest regularly. Whether you're just getting started with investing or you're a seasoned investor, it's important to make investing a habit. Investing regularly helps mitigate your fear of losses and becomes an automatic way of saving that won't take precious time out of your schedule. It also makes it easier for you to focus on long-term goals and not worry about saving every single month. If anything, you could even set up an automatic deposit into your investment account each month using direct deposit. For example, you can use something like Betterment's Smart Deposit feature or Schwab's Sub-Account Deposit program to help automate your savings. Another thing, consider setting up forced savings by automating payroll deductions into an IRA or a 401k. That way, no matter what happens in your life financially, at least some money is being funneled directly into your investments. At worst, it will allow more time for investing in education since less money is being spent on fees from low-balance checking accounts and other fees associated with underfunded retirement accounts. In essence, invest now so you have more later when you need it most. Consider how you want to manage your risk. When it comes to investing, choosing a strategy is one of your most important decisions. A good place to start is by thinking about how you want to manage your risk. You can choose from 3 basic strategies: balanced, growth, and income. Balanced funds typically have 60% or more of their assets in stocks to generate growth, with less than 40% in bonds and cash instruments to balance out the risk. Growth funds will have at least 75% of their assets invested in stocks. These tend to be volatile, but also offer a higher potential return. Income funds include fixed income instruments like bonds and cash investments, meaning they're relatively safer, but also offer lower yields over time. By knowing what you're saving for and what's driving your decision to invest now, choosing an appropriate strategy becomes much easier. For example, if you're saving for retirement early in life because Social Security benefits may not be enough to live on when you retire, a growth approach might make sense, but only if you can handle short-term volatility. However, that is only meant as an example. You'll need to do some more research before investing based on your individual situation. Again, there are no guarantees when it comes to investing. Even if something's worked well historically, past performance doesn't guarantee future results. Diversify your portfolio. Investing in your 40s can present some unique challenges. It's not uncommon for an investor of any age to be worried about investing too much money in one single security, especially if they're just starting out or don't have a lot of capital. Investors over 40 may feel more inclined than their younger counterparts to diversify across stocks, bonds, and other securities by purchasing mutual funds and ETFs. When you do buy individual securities, stick with companies that have a strong record of paying consistent dividends. You can reinvest those payments into even more stock. Diversification is key for anyone who wants their portfolio to survive and thrive over long periods. Remember, there are no guarantees when it comes to investing. Even a seasoned professional can see significant losses during bear markets or other fluctuations in market value. Always understand how much risk you're willing to take on before making your investments. Also learn how different factors influence price movement so you know what potential price movements could mean for you as an investor. Being smart about your investments goes a long way toward getting good returns from them. Even if you hire a professional to help you with your investment portfolios, it's always best to inform them of your interest in diversifying. Use tax-advantaged accounts where applicable. While tax-advantaged accounts are intended for long-term savings, they can also be used for short-term goals, such as down payments on a house or a car. The most common type of tax-advantaged accounts are 401k plans and individual retirement accounts, or IRAs. While IRAs technically don't have contribution limits, there are some income restrictions. There is no age restriction for either type of account, so you can contribute even if you're over 70. And unlike 401k plans, which come with their limitations, IRA contributions can be withdrawn at any time without penalty. This gives them more flexibility for short-term goals. Just make sure you do some research before investing your retirement money. The best part about Roth IRA investing is that all withdrawals, including contributions, grow tax-free. Since traditional IRAs only allow withdrawals after a certain age, withdrawals are taxable as income at regular rates. To get started, figure out how much cash you need to save every month to reach your goal within 5 years. For example, say you want to pay tuition of $100,000 within 5 years. You can save $2,000 a month towards that goal, and you'll meet it. But how much will those monthly savings cost you? Using a tool like T. Rowe Price's investment calculator, plug in your desired monthly contribution amount and watch as your total grows over time. It might just convince you to invest now rather than later. Final thoughts. Hire an advisor. You also have the safe option of hiring a personal finance advisor if you can afford one. You don't need to make your path to financial success too complicated, especially if you already have a lot on your plate. Family responsibilities, high-pressure jobs, managing the daily errands required to be a responsible adult, attempting to sustain a social life, and interests outside of work, it all adds up. It's fine to be overburdened by your finances. Nonetheless, you shouldn't let it stop you from achieving your financial goals. You don't have to handle it alone, especially if you have zero experience in investing. Consulting a financial advisor can assist you in making sound financial decisions that will help you reach your objectives and values. But even better, hiring a financial advisor frees up time that you could put to better use. Thanks for watching, and if you found this video helpful, click on the like button and subscribe to get more of our videos.